Good afternoon, everybody, and thank you for joining the session. I'm Joe, your host. Marty, our speaker, is in the room. We are ready for an on-time start at 2:45 Eastern. So just sit tight for a minute or two. We're going to let some other folks gather in, and we'll get started at 2:45. Thank you very much for joining the session. We'll be back to you momentarily. Hi, everybody. Welcome to the session. We're going to get started in about a minute. Marty, our speaker, is in the room. We are ready for an on-time start at 2:45. Just sit tight, and we will get started momentarily. Thanks so much for joining us with this session. Good afternoon, everybody, and welcome to the session. A couple of bits of housekeeping. We'll jump right into Marty's session. First and foremost, we want to thank everybody who joins these virtual shows as well as our face-to-face events during the year. We appreciate you. Keep your feedback coming so we can get better and better as we move forward. Secondly, depending on time, Marty can answer a couple of questions possibly at the end of his presentation. If this is the first time you're watching us, to the right of the player where you're watching Marty present, there is a chat box. Please send over any questions you have, technical questions for Marty. And again, time permitting, we'll get to as many as we can at the end of his session. We're going from 2:45 to 3:15 Eastern. With that said, it is my great pleasure to introduce and bring back to Money Show Marty Fritzen, who is the publisher of Income Securities Investor. And according to the Investment Dealer's Digest, he is, quote, perhaps the most well-known figure in the high yield world. He has served as a CFA Institute governor and a consultant to the Federal Reserve Board. Back in 2002, the Financial Management Association International named Marty the Financial Executive of the Year, and the CFA Society in New York gave him its Ben Graham Award in 2017. Marty, it's great to have you back at Money Show, sir. The floor is now yours.
Thank you, Joe, and welcome all of you for attending this session. Thank you. And I'm going to start with 5 specific security recommendations drawn from Income Securities Investor newsletter, because I know from experience that that's the number one interest in finding out, well, what do we buy? But these recommendations are spread across 5 asset categories: bonds, closed-end funds, preferred stocks, master limited partnerships, and convertible preferred stock. And the reason for that is that diversification by asset class is a necessity in order to protect yourself against market risk, because these different asset categories are affected by different kinds of factors in the economy and the financial picture. And so you really need to balance those out to maintain some steady performance while you're collecting that income. Now, after going through these recommendations, I will address the need for income growth as opposed to fixed income, and explain why it's not called the Fixed Income Investors Investment Newsletter. I'll discuss some current valuations that affect the investment picture in income securities right now, and also some economic factors that are currently affecting the investment picture. So our first recommendation is a bond. It's a Bank of Nova Scotia 8% coupon with maturity date of January 27, 2084. And this is a fixed to variable rate note which gives you protection against a rise in rates. As the Wall Street Journal reminds us almost every day, when interest rates go up, prices of fixed rate bonds and preferred stocks go down. So this will give you some cushion. Provide the CUSIP number here. This is important to have as you're putting in an order for the securities, particularly some of the bonds that trade less frequently. It's very helpful to make it easy on your broker providing some of that information. Now, all of the recommendations I'll be making are suitable for medium risk portfolios. Some of them uh, acceptable for medium and high risk portfolios, some for medium and low risk portfolios. But if you're a medium risk investor, all of these will be suitable. And in the case of this bond, because your interest uh, is taxed at the full ordinary income rate, the ideal situation would be if you have both a taxable and a deferred tax account, such as an IRA or 401k, to put the bonds into that basket, and the others that are more tax preferred beneficial from the standpoint of taxes in the taxable account. This bond is callable, in other words, can be redeemed at par or premium to par prior to its final maturity, which, as you can see, is quite a ways off. But the issue is can be called. The companies would typically do that if they can refinance at a lower rate. But you have protection until 2029. So the high rate you're getting, you can count on through that time. And if the bond is not fully called in 2029, that's when the variable rate aspect comes into place. After that point, the coupon will be equivalent to the 5-year U.S. Treasury rate plus a little over 4 percentage points. Now, in the upper right-hand corner of this slide, you see the ratings, which are Baa3 by Moody's, triple B minus by Standard & Poor's, which is just above the dividing line into the speculative grade market. And so it's important that the outlook for these ratings is stable. In other words, you're not at a risk based on anything that the rating agencies see at this point of falling below. And once you get into the BA category at Moody's, the double B category at Standard & Poor's, there is some somewhat less demand on the institutional side for bonds in the speculative grade or high yield part of the market. So that's something to avoid. Now, if you buy a bond that's already rated there, that it can represent a good value, and oftentimes, but having that stable outlook is a plus. So the issuer, as you can see here, is involved in banking both domestically, that is in Canada, and internationally. They have a wealth management business. That's a good kind of a business for a bank to be involved in because it tends to have steady fees from year to year, not quite the cyclicality that you'd see in corporate lending. And they're involved in financial markets as well as the ordinary lending relationships with their corporate customers. Now, one special factor, this does not apply to the other recommendations I'll be making here, but the price, as you can see, as of October 31st, was slightly above our buy up to price. In other words, we say you can, this is a good issue to own, but you don't want to pay too much. You want to leave some upside in it. And it was slightly above the level on October 31st. Yesterday, it closed slightly below that at 106.641, below our buy up to price of 106.75. Now, the 106, of course, is The notation for bonds, it's $1,000 face amount, but they quote it as if it were a $100 face amount. The yield on a current basis, just taking the coupon divided by the price of the bond, is very attractive, 7.48%. But you also have to be cognizant of the possibility of the bond being called. And so the most conservative estimate here, in other words, the worst yield you could get until the point at which the bond is called, would be 5.59%, still quite an attractive level for an investment grade bond. And this bond, by the way, bounced back very nicely from the low point right after Liberation Day, the announcement of the tariffs by President Trump. That was a low point around 99, and it's up by 8% through October 31st. And that's in line with, or a little better than, the price gains in that same period for triple B bonds with maturities of 10 years or greater. All right, moving on to our second recommendation. We have the preferred stock of Athene Holding Series E. This is a dividend rate of 7.75%. The yield as of October 31st, when the price was $25.70, that's on a $25 face value for this preferred stock. That was a current yield of 7.52%. And again, taking into account the possibility of a call on that issue, that was at 6.77%. So the yield to worst, and the most conservative estimate was 6.82%. The median for triple B3 rated bonds, sort of a composite of the Baa3 by Moody's and the S&P triple B, so a low triple B rating. The median for bonds of that, preferreds of that rating, were 6.09%. So you're getting significantly better yield, and underscoring the value that we see in this issue. This preferred is redeemable at par on or after December 30th, 2027. If it's not called in its entirety, it resets at the 5-year Treasury yield plus 3.9, almost 4%. And as of October 31st, 25, that would have been a yield of 7.67%. So again, we see good value here. Moving on, we have the closed-end fund recommendation. That is full name Invesco High Yield Bond Floater ETF. The ticker symbol, as you can see, IHYF. And this is an actively managed fund. They put at least 80% of their net assets in high yield, that is below investment grade, double B or lower on the S&P scale, and similar securities. It's a little bit conservative in that just 7% or so of the bonds in there are rated triple C or lower. That's toward the bottom end of the rating scale, versus about 10.5% at that level in the index against which it's benchmarked. As of October 31st, the price was, you can see, a little bit below 23. Our buy up to price there was 28. So you have a lot of cushion, a lot of room there. At 28, the yield would be 6.05%. The October 31st was a current yield of 7.787%, a yield to worst of plus 0.280. And the monthly dividend yield there was is pays a monthly dividend, and the key point there is that it has risen. Back in October, back in 2021, the dividend was running 9 to 10 cents a share on the $25 par value. Currently, this year it is run in the range of 12 cents to 15%. Now, I'll talk a little bit more about why that's so important that you, unlike with a bond at a fixed coupon, you get the potential for an increase in your payout with some of these other instruments that we'll be talking about. Master Limited Partnership here, Kimball Royalty Partners. As of October 31st, at a price of 13 and a quarter, well below our buy up to price of 18 and a half. The indicated yield there was right around 12.5%. So quite a generous yield there. It's spread out in their merchant, the master limited partnerships in most cases are very directly energy related. And this is an example of that. So it's sensitive to the price of energy. At October 31st, the West Texas Intermediate crude oil price was at 80, excuse me, at 61, down from 80 around the beginning of the year. So that accounts for a kind of a knockdown price and a good entry point in our view. That back when the price of crude oil was higher, this closed-end fund was at 16. So we do see that upside makes it very attractive. And finally, among the recommendations, the convertible preferred stock of Ares Asset Management. This is their Series B. Dividend rate on this is 6.75%, and it's convertible. It has, at the maturity date of October 1st, 2027, there's a mandatory conversion on this. It's a $50 preferred. As of October 31st, the yield was you can see almost 7%. At 47, it's well below our buy up to price of 72. Again, the upside is indicated by a high this year of 61 back on January 31st. So definitely see that as the fortunes improve for this global alternative asset manager, we definitely see upside in the price. And this security is not rated by Moody's, but it has a triple B minus by Standard and Poor's, indicating a higher rating at the bond level. So a fairly good credit backing this security. Now, I talked about the importance of getting growth in income, and here's I think a dramatic illustration of that. This is this company here, Fastenal, which makes industrial and construction products, is one of the dividend aristocrats logged by Standard and Poor's, which these companies have a record of increasing their dividends every single year for at least the last 25 years. And the reason this is so important is illustrated here. Back 10 years ago, the dividend on this common stock was 7 cents a share. It has tripled over the last 10 years to 22 cents a share. And the significance of this is that at the time, the yield 10 years ago, the yield on Fastenal was just 2.26%. And it's that, at that time, as well as today, that's not outstanding by any means. But if you look at the yield on cost, in other words, what's the dividend you're now getting compared to the price that you paid 10 years ago, that's way up at 9%. And to get an equivalent yield in the bond market, for example, as a base of comparison, you'd have to go all the way down to that bottom tier, as I spoke about earlier, of the speculative grade bond market of medium triple C2 bond to get a comparable yield. So you'd be taking a lot more risk. Here you have a growing dividend on a pretty solid company, and uh, you've increased your income in a way that has kept you far ahead of inflation. And that's the key point. The problem with owning only bonds or preferred stocks with fixed dividends is that inflation is reducing the purchasing power. If you had bought that uh, double B corporate bond back in 2015, you would, believe it or not, have lost 27% of your purchasing power, even though we think we're not in an especially high inflation environment in that period compared to what we've seen in some earlier periods. You would have been hurt very badly in terms of what those dollars you're getting can buy. But the dividend on Fastenal has grown at a 12% annual rate, keeping you far ahead of inflation, which has run at just about a 3% period during that rate during that period. And by the way, although we're not emphasizing the total return in this case, we're really saying how can you increase your income over time? You had an annualized total return of a not at all shabby 18.25% over that 10-year period. So, not every dividend aristocrat has shown this kind of record, but on average, they doubled their uh, dividends over the period. Now, of course, what you need to know is you've got to find companies that have the potential to increase their dividends consistently over the next 10 years. So that's another issue. It's not just a matter of looking at the list of the current dividend aristocrats, but it is an indication of the power of this concept. And particularly if you're still, let's say, a decade or more away from retirement, it would make sense to have this be a very significant component of that portfolio that you're looking for eventually to provide income in your retirement years. And even if you are already at or near retirement, it makes sense to have a component of your income portfolio in this kind of investment that can grow in income over time. Um, Moving on to say a little bit about what's going on in the market currently. Unfortunately, risk premiums are low by historical standards. How much are you getting paid for the additional risk of owning a corporate security, which has a meaningful default risk? Although we'll talk about that versus treasuries, which are for these kind of purposes are considered to be default risk free. And we're looking back over the period 1997 when some of this data is first available. You can see that all three of these investment grade, preferred stocks, investment grade, and high yield or below investment grade corporate bonds are all, as of October 31st, in that middle column, below their medians for a effective yield. Um, uh, and the most overvalued by this measure are the investment grade corporate bonds, the least undervalued, the investment grade preferred stocks. So it's you have to proceed with some caution right now. There's some argument for keeping some of your money in shorter term, high quality bonds that will be mature in a period a few years out. Perhaps yields will be higher at that point. So that'll be an opportunity to invest at more attractive yields in the future. Okay, here we talk about an unusual situation that's happened since the Fed began lowering interest rates. You can see that the green line representing the 10-year Treasury yield has actually risen during the period where that blue line the interest rate controlled by the Fed has been declining. That's quite unusual. In the last 6 periods of Fed easing, lowering interest rates, consistently the 10-year Treasury yield went up during that period. Now, the Fed only controls the short-term interest rates. It's not surprising that the longer-term 10-year Treasury yield can move somewhat independently of that, but this is kind of an extreme case of that. And it was particularly so, as you can see, in the first 3, 4 months, where the 10-year Treasury yield rose very dramatically, even as the Fed was lowering rates. And that could reflect some concern that if the Fed gets carried away with this rate decrease, particularly with the pressures that are unusual in anything we've seen in the last 30 years or so in terms of pressure from the White House to be lowering rates, that could trigger inflation, and in that case, or a higher rate of inflation, and in that case, the long-term rates would certainly not come down, but go up higher. There's the tariffs could have that inflationary effect as well. Jury is still out on that, but there's also the possibility that the rising federal deficit would have an adverse effect, creating more Treasury supply and pushing the rates up just on a supply and demand basis. Here is a slide I present slightly facetiously, but it is noteworthy that Harvard University, among others, that the government has been looking to take money away from, actually has higher rated than the U.S. Treasury. The Fitch most recently in 2023 lowered the government from the highest rating of AAA. So I would say, well, where would you feel better with your money being, a AAA or a AA? And again, I present that somewhat facetiously, but it is kind of a striking illustration of where things stand currently. And that is related in significant part to this slide, which shows the growth in the federal deficit here as a percentage of gross domestic product. And I've heard, as long as I've been in the business, which goes back more than 4 decades, we're close to 5 decades now, that oh well, that government is a spendthrift. They're ruining us with their deficits. And well, the national debt at the time when I started was significant, but not something that was going to break the bank or put the government into default, certainly. And so I think a lot of those people were alarmists. They thought that, oh, you have to be like a household, and if you get into debt because you have a tough year, you have to pay it back, get back to zero. That's not. I don't think you'd have too many economists that say the optimal amount of the national debt is zero. But you can see that we've really taken off. Typically, you've seen deficits and federal debt rise as a percentage of gross domestic product during recessions, and then it kind of eases back as tax revenues increase. But we really ratcheted up to a much higher level back here at 100% of GDP. You had a very influential research report that came out a few years ago by some economists saying, well, once you get to that level, you're really at great risk. And we've gotten well above that level now. One other point I'd want to make about the financial environment we're in is where the Fed is. I've kind of created this spectrum. If you move from the upper left-hand quarter, we could have no Fed. We could just have the dollar tied to the gold standard, and we had that up until 1913, but we've moved well beyond that. The next step to that would be to the right, the Taylor rule, which is a fixed rate, not the Fed making any real decisions, but just following a formula for the Fed funds rate based on inflation and the percentage differential between the current real GDP and the long-term trend in GDP. We're clearly not at that. We have the Fed with discretion. Their mandate under the legislation, the Humphrey-Hawkins Act of 1978, says that they're supposed to aim for stable prices. In other words, no inflation. They've rejiggered that to say, well, 2% equals no inflation, and balance that with a full employment mandate. But in fact, the Fed's is somewhat subject to mission creep. People expect them to uh, avoid a collapse in stock prices. That's not in the Humphrey-Hawkins Act, and neither is anything related to the exchange value of the dollar. But there's increasing expectation, and the Fed has kind of acted as if, at times, as if that is part of their mandate. And I wouldn't be excited, pleased if it went to the extent of saying we're actually going to make that part of the law, that is part of the Fed's mandate. But I think that is a concern on the inflationary front of that possibly expanding mandate of the Fed. So I think we're about out of time. I'm sorry, I won't have time for questions unless we can squeeze one in the remaining minute. I do encourage you to take a look at the uh, newsletter, which talks about these kinds of issues and makes new recommendations every month in the asset categories that I spoke about. And I know, Joe, I'll leave it to you if
Yes.
there is time for a question in there. Happy to address it.
Sure, we had a great crowd. Thank you very much. Very informative, Marty. And again, it's www.isinewsletter.com where you can find Marty and his work. One quick question before we go. Marty, do you believe there's any significant chance of a federal debt default before the end of Trump's term? And how much worse would this be for the average American than the 2008 and 2009 crisis?
Well, a flat out default would be quite serious. I mean, that would certainly qualify as a financial crisis. And we haven't had it, so it's hard to predict exactly what would happen. But we've seen certainly major disruptions when there have been defaults in the 1990s at Russia. That had repercussions even in the U.S. markets and around the world. And of course, Argentina has defaulted many times in the past. It has uh, penalized any country that has defaulted has been penalized for many years afterwards in the confidence that the market has in their debt, and therefore the interest rate they would have to pay. And the higher rates, of course, would be very damaging not only to the bond market but to the equity market as well. The U.S. did default in technical terms when they made in the 1933, the government said, we're going to take possession of all the gold, and the bonds that were payable in gold will no longer be payable in gold. And the Supreme Court validated that, probably not on good legal grounds, but politically was seen as a necessity. So there was in effect a default on those, a small portion of the total Treasury debt outstanding at the time that was payable in gold. And then more recently, in 1979, the government actually failed to make payments on time, which is part of the definition of default, on some Treasury bills because they had computer and bookkeeping problems. And they rectified that fairly soon, but did technically qualify as a default. So it's, again, that AA rating on the U.S. Treasury is not entirely unfounded based on its record, where Harvard University has never defaulted on its debt, though it's facing some financial challenges along with other universities at present.
Terrific. Marty, we very much appreciate you. Great session. A lot of good questions in the room. Sorry we couldn't get to all of them, folks. But with that said, Marty, we appreciate you at Money Show. Thank you for educating the investors that come to these events. Folks, thank you for joining us at the sessions yesterday, and enjoy your sessions through the rest of the day. Marty, thank you again. You guys have a great week and a great Thanksgiving, and we hope to see you guys again soon. Thank you again, Marty.
Thank you.
All the best to you.